All right. We're on to our next market. We're not going to do a market on this one. We thought it'd be interesting to get a sponsor in here, an investor, to talk about this from a different viewpoint. So we've got Ben Bucci from Lincoln on the podcast. Again, this is Chris Roth, the chapter president of SIOR. And so, Ben, just like I'm asking everyone, you probably know most of the agents in the chapter, but let's just get out of business for a minute. Just real quick, tell us a little something about yourself, where you're from, where you grew up, where do you live now, what do you do for fun?
Yeah, sure thing. Well, thanks for having me, Chris. Pleasure to be here. I'm originally from central New Jersey. Actually, I've been in California now for about a decade. San Diego for, call it, 7 or 8 years. Bought a house in Point Loma about 2 years ago, so lived down there with my wife and my 2 dogs. During my free time, which I seem to have more of these days given the current market climate.
Good for you, man.
Yeah.
Not.
Depends how you look at things, right? Love to get out and golf, especially if there's a business aspect to it. Snowboarding, traveling, going to the beach, pretty casual stuff for the most part.
Nice, dude. Well, let's get into it. So the investment market has changed dramatically over the last 12 months. I don't know if you noticed, but interest rates went up. And so there was a lot of things that happened with our team where a lot of buyers, their equity partners bailed, or we just heard a lot of, hey, pens down, all this kind of thing. So I'm just curious, what was your interactions with your equity partners like over the last 12 months? How was that? What was their message to you, and how has that changed maybe?
Sure. So I think traditional LP equity, and by traditional I mean your life cos, your life insurance companies, your closed-end funds, your open-ended core funds, can be characterized as being extremely selective. Deals would need to check virtually all of the boxes, so to speak, and typically have some type of hook, whether that's a tenant in tow or some type of insider knowledge, not readily available to the marketplace. That being said, in the past kind of 4 to 5 months, we have seen a bit of a thawing out in the equity marketplace. The reality is there's a ton of dry powder, capital on the sidelines that will need to be allocated, invested. So we're seeing groups come out of the woodwork and begin engaging on opportunities again, albeit not at the levels that we saw, call it 18 months ago. But there definitely is some encouraging activity out there that at least we're observing.
So let's call it pre-5 months ago. They were just like, don't even call me unless it's an amazing deal, essentially, right?
No, these guys, they want to always stay in the market, right?
Yeah.
And have real-time data, so they wouldn't say, don't call us.
Yeah, but, right.
We learned that, or at least my perception is when they say selective, it basically meant that they were out of the market unless they found a unicorn.
And you're seeing that change. They're getting more open to deals again.
Absolutely.
Cool.
Yeah.
All right.
Absolutely. Much more engagement.
Good. So as brokers, we've heard a lot. The debt market is too volatile to transact. We're just hearing that created a huge slowdown in activity. Sure. From a sponsor's point of view, dealing with it on a day-to-day basis, can you shed some light on what that means from your perspective and how it made life difficult when trying to get a deal done?
Yeah, absolutely. So, I wouldn't say it's volatile as much as there are just certain challenges with the dynamics in place. But most important is banks aren't lending, whether it's the money center banks or the regional banks. They're out of the market right now as they focus on fortifying their balance sheet. So there's a void in the debt capital markets that's being filled by more expensive debt, right? So it's challenging as a sponsor and as a partnership, frankly, because debt costs 18, 24 months ago, all-in coupons were, call it 3.5% to 4.5% for, a value-add type industrial play, whereas now that coupon can be as high as 7.5% in some cases, which is, it affects returns and purchase prices massively.
But wasn't there, let's say you go under contract, I thought there was maybe a play in you can't go under contract and price out a piece of real estate because the interest rate hikes are going to change in 30 to 60 days. So it's like you couldn't really even, it's hard to value because you just didn't know where it was going to be.
Fair point, especially during the run up where the Fed was increasing by 50 basis points every meeting. If you got caught in the center of that,
Right.
when you were in escrow, the debt landscape would change massively overnight. So certainly, it's gotten a little bit better where you kind of understand where the debt market is, but it's certainly still a challenge to source debt for new opportunities.
Got it. How have you seen your valuations when you're looking at, and this is just a generalization because there's a lot of different product type, but how have you seen pricing change over the last year as a percentage, just a general number?
Yeah, I think it's about 20 to 25%.
Okay.
Plus or minus.
That's kind of what I've been hearing.
Yeah.
Has the type of real estate you're chasing changed over the last 12 months? And I say that because I'll tell you, in 2021, it was like I could get anybody to buy anything. It doesn't seem like that's the case anymore.
Yeah, I'd say as a sponsor, oftentimes we're catering our strategies to what our equity partners want. That being said, in today's environment, a lot of our typical partners in our equity stable are looking for cash flowing assets with yield in place. Taking on future lease up risk is not exactly in the crosshairs currently right now. The focus is on secure cash flow. I think multi-tenant versus single tenant is preferable to kind of diversify that cash flow stream. We've talked that single tenant assets can be very challenging in today's environment. Whereas 24 months ago, it was a risk-on type environment. I was seeing pricing for vacant industrial above that of cash-flowing industrial. So that's kind of reversed at this point.
Okay.
And there's a massive emphasis on higher yielding investments.
Got it. In early 2022, it seemed like there was no issue trying to find a buyer for stabilized real estate. And then by that, I just mean, like you said, maybe a single tenant long-term lease or something along those lines. Now every phone call I get from an investor is we're a value-add buyer. Mm-hmm. You kind of touched on it, but why is there a lack of money chasing the long-term lease properties?
Yeah, it's a great question. And I think there's a variety of reasons, but I like to think about it very simplistically. For industrial SoCal, a long-term lease, typically the seller would like to price that in a low 5 cap range, plus or minus. And the challenge there is, I think there's a couple challenges, but why take on the real estate risk when somebody can go buy a 10-year U.S. Treasury with zero risk at a 4% yield? Right. That's the risk-free rate. 100 basis points of risk premium is probably not appropriate.
Right.
So that's one aspect. The other thing to consider is we have historically, the past 24 months, been in a highly inflationary environment, which has driven rental rates up. So by locking yourself into a lease that has 2.5-3% bumps at already below market rents,
you're going to be behind.
On a relative basis, you're behind. You're going to have to actually, from the equity side, you're going to have to mark that asset down in the next year, just given where the market has gone. So it's kind of an odd phenomenon because I think we're in uncertain times, and you would think these long-term lease credit deals would be attracting a lot of attention. It's not playing out that way. People like multi-tenant, industrial, low WALT, the ability to mark to market and achieve a more compelling yield.
Gotcha. That all makes sense. So, since everyone's a value-add buyer, this is a tough question to answer. I know that, but I am just curious. Maybe it's just a metric question or a general question, or what do you and other investors? What are you seeing? Like, what are you focused on achieving? Is it the yield? And what metric are you looking at?
Yeah, I think more than ever, the metric we're focusing on and our capital partners are focusing on is the untrended return on cost. And And that untrended return on cost, I think we're looking for, a reasonable spread to in-place cap rates. That's the primary metric. There is a heavy emphasis on all-in investment basis today, including debt service, right? It's not just purchase price lease-up costs anymore. We're dealing with 7% coupons plus, so that debt burden needs to be factored in as well. So it kind of answers succinctly, return on cost and all-in basis are the two most top of mind focal points.
What about the next 12 months? No one has a crystal ball, but gotta ask you, man. I mean, if just your best guess, what's the next 12 months look like for the investment market?
Yeah, I anticipate a lot of the LP capital to return to the marketplace in Q1 and Q2 next year. I touched on it earlier in our conversation, but there is a wall of dry powder that is going to have to be invested. Equity guys do not like, or they prefer not to return capital to their investors. So that's something to watch out for, more active LP capital. And I am a believer that debt capital is going to become more abundant. I think that there are going to be innovators that step in and fill the void that the banking sector has created with their lack of appetite to lend in this current environment. So to kind of put a bow on it, my opinion is that I think there's going to be more prevalent capital going into next year, which should bump up transaction volume, not to the levels that we saw or witnessed 2-3 years ago, but certainly above what we're witnessing right now, which feels like we're kind of bouncing on the bottom.
Okay, that's good to know. Switching gears a bit, GMP life science kind of blew up during COVID.
For sure.
Take me through just that, what happened there and where it is today.
Yeah. I'm going to focus more on GMP since I think this is like industrial focus for the most part. So the reality is growth sectors, whether it's tech or life science, were absolutely pulverized as the Fed increased the Fed funds rate at the fastest clip in history. So the GMP marketplace has been a casualty of tighter monetary policy, right? The effects to the tendencies or normal tenants that seek GMP space is they're putting a governor on growth. And on top of that, they're looking for more cost-effective options for GMP, which has seen them go to more tertiary markets with an abundance of blue-collar capital and also private-public partnerships. And those typically take place with jurisdictions that can provide land or incentives or in some way, shape, or form. And those just don't really align with San Diego, right? It's a very expensive marketplace. Land is expensive, labor is expensive.
Yep.
And GMP, although you do need those PhDs and chemistry folks there, a majority of that labor force is more blue collar in nature. So there's been several obstacles to the growth of that sector in particular in San Diego.
Do you see that changing?
I think next cycle you're going to see GMP reemerge.
Yeah.
I don't know that it's ever going to hit the critical mass that a lot of folks projected.
Right.
Some of it is secular, like the private-public partnerships. I don't know that you're going to be able to replicate that to the extent that some tertiary markets have, but you're definitely going to see the sector reemerge and take shape later down the road.
Cool. Talking about leasing activity, there was a number of large companies that took down a lot of distribution space.
Sure.
Post-COVID. How do you see the tenant activity right now for those large companies and general e-commerce distribution related activity? What are you seeing right now?
Yeah, certainly have read about and heard about these major retailers and 3PLs slowing down in some cases, pausing warehouse expansion for the time being. The reality is this subset of tenancy has expanded exponentially in the past 3 years. And
Totally.
I think in some circumstances they're in a wait and see mode to see if the supply chain they've created is adequate to serve their customers. And in some cases, Amazon is a great example. They may have overextended and are looking to offload some of that space. So in further kind of exacerbating the lack or the slowdown in absorption is we are in a freight decline, right? I think in some cases, freight volume going into LA is down 30 to 40% plus or minus, and that has a correlation to the amount of space being taken. San Diego is fortunate in that we're a border market, right? And so San Diego, and particularly Otay Mesa, continues to benefit from that nearshoring trend. So on a relative basis, we think San Diego is going to outperform in Southern California.
All right.
Yeah, so good news for us.
Yeah.
The party continues.
Yeah. Let's move to development. That's obviously been more challenging, I think, as of late. But walk us through some of the challenges you're facing on potential development deals.
Yeah, I think it's construction cost increases, lengthy entitlement and permitting processes, and just general market risk make development a difficult proposition in the current market climate.
That's fair. How are lenders viewing those deals? Are you seeing any debt dispersed for that?
There's debt out there.
There is. Okay.
I'd say debt capital is tougher to come by. They're certainly more cautious, more selective. The preference is to have a permit-ready project. Finding a land loan as you go through the entitlement process is definitely more challenging than it was 2 years ago. So, there's debt capital out there, but it's no walk in the park to find it.
How has your viewpoint changed on chasing development deals over the last year? What attributes does a deal have to have in order for you to get excited about it?
Yeah, look, it's a tough market. I think our assumptions, our costs, the market risk, every aspect of a development needs to be heavily scrutinized, or more so scrutinized, just given kind of some of the headwinds and uncertainty that we're witnessing. For us to chase a development, it really needs to tick every box. And what I mean by that is we need to be able to build exactly what we want to build. We need to have extreme comfort with the entitlement process. And ideally, it's when we're purchasing the land, it is entitled and it's permit ready. So the emphasis is on de-risking development investments as much as possible before you actually close on the land.
Got it. I'm going to ask everyone that's on this podcast. You can try to be funny, you can try to be serious, whatever you want to do, but give me some sort of a prediction you haven't already given that's going to happen maybe 12 months from today.
Yeah, I think my golf handicap is going to go down 5 strokes.
That could be true with your time. There's so much time in there.
I think you're going to see real estate professionals taking the most time off that you've seen in the past 6 months.
I've seen it in this office already, Ben. So
exactly.
don't you worry about your predictions coming true.
Which is a good thing. Everybody can take some time off,
get family time,
fresh air, and then come back strong Q1 next year.
All right, Ben. Thanks, buddy. I appreciate you coming in.
Yeah, of course. Appreciate it. Thanks for having me.